I'm Catherine from AQUMON. So in today's webinar, we will walk you through about some of the 2021 financial market review and also outlook of 2022 with some data-driven insights and trends. So in today's sharing, it will be divided into 3 parts. So one part is about the review and outlook, and one part will be about what particular themes and trends that will be very important in the coming year. And lastly, followed by a performance review of our AQUMON most popular portfolios. So in today's presentation, we are very honored to have Dr. Arthur Lei, who is the Chief Economist and Lead Quantitative Scientist in AQUMON, who oversee all the strategies and investments planning of AQUMON. And we also have Anson Leung, who is the Wealth Manager of AQUMON, to share about the portfolio review of our key or flagship products. So maybe let's pass the stage to Dr. Arthur Lei.
Today, I'm going to deliver 3 parts. The first one is the macroeconomic and market review for 2021. And the second part is the macroeconomic outlook for 2022. And the last part will be the investment outlook. So let's begin. First of all, before we go on the macroeconomic review for 2021, we would like to look at the impact of the outbreak of COVID-19 pandemic to the global economy first, because it is the driving force for the last 2 years and even the next 1 year. And we can see that before the outbreak of COVID-19 pandemic, actually the economic states for different countries are different. The US is in expansion state, and most of the DMs are in bad states. For example, EU is in recession, UK is in stagflation, Japan is in recession, and China was experiencing inflationary slowdown. However, there was, after the outbreak of COVID-19 pandemic, there was a synchronicity in the stimulation policy. We can see that for the developed markets, the most important stimulation policy was expansionary monetary policy plus expansionary fiscal policy, especially expansionary monetary policy. For example, for the United States in the year 2020, after the outbreak of COVID-19, the M2 of the United States grew for around 25%. That was the highest after the Second World War. And however, for China, it is another route of recovery. We can see that China has a very strong expansionary fiscal policy plus a neutral monetary policy. And because of the difference in the stimulation policy, we can see that the economic results can be different. For example, for the developing markets, especially for the United States, as they create a lot of money, therefore, it is expected to experience a high inflation afterwards. And we can see that in the last year, in 2021, the United States and most of the developed markets, they experienced a high inflation. And because their stimulation policy is on the monetary part and almost on the demand side, therefore, their production side actually suffers a slow recovery. That is another cause of the high inflation. But for China, the results are different. Actually, China's production recovered soon after the outbreak of COVID-19 pandemic. However, its consumption suffers a lot. Actually, the growth rate of consumption is still very low right now. And the good thing is that the inflation for China is still low and can be controlled in the future. And now we can see that the evolution of global macroeconomic states in 2021, and we show you the most important 5 economies here. The United States, actually the growth rate or the economic growth was quite good for the United States in the first half of the year, and we can see that in January experienced expansion with no inflation and a high growth. However, as we predicted that it has a lot of monetary stimulus, therefore it started to experience high inflation after February, and we see from February to August, it was an inflationary boom. Afterwards, in the third quarter, because of the outbreak of Delta virus, the growth of the United States slowed down, and we can see that in the last few months, it actually experienced a kind of states between inflationary slowdown and stagflation. Actually, it cannot be defined as a stagflation like what happened in the 1970s. However, it's towards that kind of state. And for China, actually, China experienced an expansion in the first few months, and in fact, the economic growth was slowing down in the first half year and remained low in the second half of the year. And we can see that finally, we see that China actually was experiencing something like a recession there, and Japan is another story, and because of Japan the economic growth for Japan was quite low in the last 30 years. Therefore, although it prints a lot of money after the outbreak of COVID-19, it still went to recession during the 2021, and now it is in a state of disinflationary recovery. And let's have a close look to the macro indicators and the policies of the United States in 2021. And we can see that the growth of the United States was strong in the first half of the year in 2021. The growth of GDP was above 6% for the 2 quarters. It was really high for the United States. And we can see that the PMI YoY growth were all above 50. That was quite strong. And however, for the third quarter, because of the outbreak of Delta virus, we can see that the GDP YoY growth was quite low at that time. And now the market expected that the GDP YoY growth for the next quarter would be 5%. Let's see what will happen in January 27th. And there is also a risk that we can see in the next month, in December, the PMI actually went down a little bit. And the second thing we can see quite good for the United States in 2021 was the labor market. For the labor market, we can see that the labor market recovered gradually. The unemployment rate this night line went down steadily, and eventually in December it went below 4%. And from the non-farm payrolls, we can see that in the first half of the year, the non-farm payrolls are quite good. And however, it went down significantly, systematically in the second half of the year after the outbreak of Delta virus. Therefore, there is still some risk there. And the key theme for the key macro indicator for 2021 for the United States was inflation. Actually, we can see that after beginning from March, the inflation went up above 2%. That was the target rate for the Fed, and it went to 7% in December. That was the highest over past 40 years. And we can see that the economic policies in the United States in 2021 actually changed dramatically. In the first half of a year, the Fed often held the view that the inflation can be transitory, and the Fed will focus more on labor market than inflation rate. However, in September, Fed announced it could begin gradual tapering process by mid-November and accept that the high inflation can be non-transitory. And in November, Fed started the tapering process by $15 billion per month. And in December, because of the inflation statistic of November came out, and it was the highest in last 30 years at that time, Fed accelerated tapering by $30 billion per month and mentioned potential interest rate hike for 3 times in 2022 and another 3 times in 2023. And we can see the fiscal policy here can be, for the fiscal policy, the first important thing is that before October, actually, the US government was risky to reach a debt ceiling on October 18th, and which was suspended to December on October 6th. And the Congress in November passes $1.2 trillion infrastructure bill from President Biden, which was initially said to be $3.5 trillion. So less than half of the bill was passed. And in December, Biden signed a debt ceiling increases by $2.5 trillion. That's all the policies for the United States in 2021. Because of those policies, we can see that there was quite dramatic movement of the US 10-year Treasury yield. In the first few months of 2021, the market was fear for the high inflation going on. Therefore, the US 10-year Treasury yield went up to above 1.6%. However, as the Fed continues to say that the inflation can be transitory and the market kept the same expectation, therefore, in the next few months, the US 10-year Treasury yield went down. And afterwards, in September, when the Fed accepted that the high inflation can be non-transitory, the fear of high inflation went up again, and then we can see that the yield rose again in the last few months and reached to 1.8% in recently. And we can have a close look at China. For China, for the economic growth of China, we can see clearly China experienced a slowdown in 2021. First of all, we can see that the PMI went down from 51.9 to 49.2 in the from March to October, and now it's still although the PMI of China is now above 50.3, the level is still low. And we can see that for the three driving factors for China's economic growth, the industry value added and the retail sales of consumption goods is still very low. For the first half of the year, these two components actually slowed down significantly. We can see the year-on-year growth, and those two components kept in a low growth for the second half of 2021. And the most important driver of China's economic growth was foreign trades, and we can see that foreign trades maintain stable and slowed down a little bit in December. However, there can be a risk that the foreign trades, the exports of China, may decline in 2022 as the production side of the developed markets recover, and it can be a bad thing for for China's economic growth. And we can see clearly that for the statistics of the GDP one growth for the 4 quarters of China, the statistic declined significantly throughout the year. And now let's look at the inflation part of China. For China, the inflation part can be complex because we can see that China is experiencing actually a low inflation from the consumption side or the demand side. We can see that the CPI is quite, the year-on-year change of CPI is quite low in 2021, and even is lower than 2%. And strangely, the production side for the PPI and the raw materials, actually the price of the raw materials went up significantly during 2021. And we can see that PPI peaked at 13.5% in October. And afterwards, because of some of the policy or regulatory impacts, PPI declined significantly in November and December. And let's see the economic policies of China. For the first half of the year, actually China's monetary policy was quite neutral. So the PBOC released 2021 first half report mentioned the monetary policy should remain robust, preventing economy overheating. This was the statement at that time. So at that time, Chinese regulatory power or policymakers focusing on the economy overheating. However, start from July to December, actually China experienced two required reserve rate cuts, and also there was a decrease in the LPR by 5 basis points, and we can see that in the second half of the year, China's monetary policy became more and more loose. And for the fiscal policy, actually, most of China's fiscal policy is related to the tax benefits for the corporations and for the households. And we can see that because of these policies, the 10-year Treasury bond of China, the yield of 10-year Treasury bond fluctuated in the first half of the year and went down significantly from above 2.3% to around 2.8%. And recently, I think it went down below 2.8% after the interest rate cut announced on January 17th, just a few days ago. And for the asset performance, we can see that for the 2021, the most performing assets are the commodities, especially the energy sector. We can see that the oil prices went up over 50%, and the real estate markets were also good. For the United States, the real estate index went up for 44%, and we can see that most of the real estate markets around the globe went up. And we can also see that there is a distinction or the dispersion in the stock markets and in the bond markets. For most of the developed markets, because they adopt expansionary monetary policy, so the liquidity of the stock markets are quite good. Therefore, we can see that they actually experienced a good stock market. And for the US, S&P 500 actually went up for around 26.89%, and the other end was China, Hong Kong, and the other emerging market. We can see that China, because China suffered from the economic slowdown, and most of the Chinese assets are under policy uncertainty, especially for some of the sectors. Therefore, the Chinese assets actually performed badly during 2021. However, for the bond markets, it flipped over. We can see that because of most of the developed markets, they suffered from inflation. Therefore, their bond markets actually performed badly in 2021. However, for China, because as we mentioned before, the Chinese 10-year Treasury bond yield went down significantly. Therefore, the bond market went up. So that's the asset performance review for 2021. So let's look at the macroeconomic outlook for 2022. Here we have the summary here. For the United States and the other developed markets, we think that they may experience stagflation to slow down, because first of all, their economic growth can stabilize in 2020 with the control of COVID-19 pandemic, and high inflation will continue in the first half of 2022 and may get controlled in the second half of the year, depending on Fed's rate hikes and the potential runoff. The Fed is highly likely to conduct interest rate hikes for at least 3 times and may warrant a rapid rundown of Fed's asset holdings to draw excess cash out of the financial system. The United States 10-year Treasury yield is expected to surge to 2.13% at the end of 2022. The market liquidity is expected to shrink in 2022. For China, it's another story. We expect that China will experience recession to recovery. For the first half of the year, China's economic growth can continue slow down and get to recover in the second half of the year. The CPI of China may rise as the upstream prices will finally transfer to the consumption side. However, the raw materials prices and the PPI is expected to stabilize in 2022. As we mentioned before, actually, we can see that in the last few months, China's raw material price and PPI went down steadily, and China's economic policy focuses more on stabilizing its economic growth. Hence, its monetary policy is now expansionary, and there is expected to be further rate cuts and required reserve rate cuts in 2022. So let's look at the United States. There are two challenges faced by the United States economy. The first one is the high inflation. Now it is non-transitory due to supply chain constraints during COVID-19 pandemic in the short term, and a persistence in wages in the midterm and global carbon emission reduction in the long term. We can see that the weekly earnings here, the dark line went up significantly after the outbreak of COVID-19, and we can see that it is positively correlated to the inflation, to the CPI, and it can be a persistence factor for high inflation in the midterm. And also, Omicron is now placing pressures on the US healthcare system and negatively impacting operating rate, leading further concerns on the supply chain constraints. We can see that the statistics here is quite severe. And however, we still see opportunities for the US economy. First of all, we see that COVID-19 pandemic may be controlled as vaccination rate is now high enough and the death rate for Omicron is low. And also the unemployment rate keeps falling for the United States. Finally, we see that the US economic growth is expected to be 5% year-on-year growth for 2021 last quarter from the consensus point of view. And we also believe that the economic growth can stabilize in 2022 due to the control of pandemic. Now let's see the US monetary policy. So for first of all, the Fed is expected to raise interest rate 3 times in 2022, as early as in March. So this part can, the certainty is now higher and higher, and at least the Fed is expected to raise interest rates in 2022. However, there is still uncertainty whether the Fed will cut its balance sheet assets or not, because the need for the Fed to conduct a balance sheet runoff is that if it only conduct rate hikes, then it will push the yield curve flatter and flatter, which can introduce systematic risks to the financial system. Therefore, there should be also a kind of quant method to deal with the yield and deal with the interest rate. Therefore, there is a need for the balance sheet runoff, and there is a chance for the Fed to conduct a balance sheet runoff in the second half of the year if high inflation continues. And we can see that. So for the 9 points these 9 points are the Fed total assets. It almost doubled after the outbreak of COVID-19 pandemic, and we also see it highly correlated with the S&P 500 indexes. After the rate hikes and the potential balance sheet runoff, we believe that the liquidity will shrink for the market, and there can be risks for the US stock market. Therefore, we see the potential outcomes of the US macro states. The first of all, interest rates will definitely surge and the discount rates for the risky assets rise accordingly. The second one is that the market liquidity shrinks due to the contractionary monetary policy, and financial performance of the US firms stabilizes in 2022 as the economic growth can stabilize in 2022. For China, there are also challenges faced by China's economy. The most important one is from the demand side. We can see that China's consumption is still weak due to the slowdown of disposable income growth. And we also see that the real estate sector in China faces challenges from the decrease of net population growth, as well as the recent credit risks. And the high export due to COVID-19 pandemic may not be sustainable for China after production recovers in the developing economies. And we can also see that the CPI of China may rise as the upstream prices will finally transfer to the consumption side. There is a huge gap between the consumption side and the raw material or the production side. And there are also opportunities for China's economy and its stock market and bond market. We can see that China's economic policy focuses more on stabilizing its economic growth. That's a good thing. We can see that the benchmark interest rate dropped by 10 basis points on January 17th. And China adopts expansionary monetary policy and conducted a rate cut on January 17th. There is plenty of room for China's monetary policy. We can see here for China's M2 growth, actually before the outbreak of COVID-19, it is around 8.5%. After that, it went up to around 11%, and in 2021, it went down again to 8.5%. So we can see that there is plenty of room for China to adopt an expansionary monetary policy and create more money to deal with its economic slowdown. And also raw material prices and the PPI is expected to stabilize in 2022 as the global supply chain recovers when COVID-19 pandemic gets controlled. So we have here we have the potential outcomes of China's macro states. First of all, interest rates will definitely decline, and discount rates for the risky assets decline accordingly. And also the market liquidity rises due to the expansionary monetary policy. The financial performances of the private sectors may continue to be fatigued due to the economic slowdown in the first half of the year and may recover in the second half of the year. And let's look at the investment outlook for 2022. So here we have a quantitative macro asset evaluation system. We try to categorize economic states into 8 groups from the low inflation part to the high inflation part, and we have expansion, slowdown, recession, recovery, and we also have inflationary boom, inflationary slowdown, stagflation, and inflationary recovery. We try to find the expected cash flows performance in each state and also the discount rate in each state, and try to summarize what is going on for these assets price movement in each state. Therefore, we have the views on asset classes for 2022. First of all, for the for the stock market, we see that the US, we have neutral views on the United States stock market because for the discount rate and the market liquidity, it is bad for the US. However, we also see that the economic growth is still steady for the robust for the US. Therefore, we see that there may be risks for the US stock markets, but if it went down or not, there can be opportunities also for the US market. For China, we hold a positive view for its stock market as the liquidity and the discount rate went down, the liquidity goes up for the Chinese stock market. Also, we hold the same positive view for Hong Kong stock market, although Hong Kong shared the same kind of valuation system and discount rates as the United States. However, we know that in 2021, the Hong Kong stock market went down significantly, and for most of these assets are now undervalued and compared to assets in the United States. Therefore, we think that there are opportunities for the Hong Kong stock market. And for the other developed market, we also hold the neutral view. For bond market, definitely most of the developed markets, they share the same monetary policy, and their interest rates will go up in 2022. So we hold a negative view. But for China, as we mentioned, China is adopting an expansionary monetary policy. So the bonds market for China can be quite good in 2022. And for crude oil, as we see that there will be interest rate hikes in 2022, and therefore dollar can be strong in 2022, and we think that energy price there may be risks for energy prices, also for gold prices. For the other commodities, as we believe that the production side for the developed markets can recover at least the second half of 2022. Therefore, there can be a strong demand for the other commodities. Specifically for the global equities.
Sorry to interrupt, Dr. Lei. So one of our guests, Mr. MC, just asked for the other commodity, like back to the previous page. Does it also include cryptocurrency?
For cryptocurrency, we think if there is a strong dollar, it can. So for cryptocurrency, there can be risk for cryptocurrency. So for other commodities, we do not include cryptocurrency. And for the global equities, we hold positive views for the Asia growth assets, Hong Kong growth, because for these two parts, we know that the Chinese assets, Chinese economic growth actually slows down in the first half of 2022. So growth assets are quite important and can be distinguished out from the other assets. And we also hold positive views for the US financials and other DMs financials because the interest rate hikes can generate more revenues for these sectors. And we also hold positive views on the new energy sector. For the neutral part, we hold neutral view for Asia value, Hong Kong value, and the US value. But we hold negative views on the US growth, at least for the first half of 2022, and the US tech and healthcare, other DM healthcare and the emerging market stocks, due to the shrink of liquidity and potential economic slowdown for the emerging markets. But what if we do not know how to invest? I think one suggestion is to adopt global asset allocation to have a good diversification for your assets. That's one of our advice. And finally, in the last part of today's sharing, I will share a little bit about AQUIMON's new function. We introduced a function called Smart Advice. So before the introduction of Smart Advice to the market, investors search for the products. So basically, the kind of theme is that an investor try to search for what products are suitable for them. However, we try to make it into the other way around. We try to have products to search for investors here by Smart Advice. And the theoretical ground for this part is that we have an intertemporal dynamic asset allocation framework here. We try to model the asset allocation behaviors and its objectives to maximize an investor's lifetime expected utility of their going forward consumptions, and try to have mean variance and investment opportunity risk optimization, which is developed out of mean variance optimization, and we will have different preference bundles for the investors to choose, and try to understand the investors. And finally, we match the most suitable products to the investors. That's the whole process for Smart Advice. So this is all from today's sharing. Thank you very much.
So maybe I can pass the stage to Anson so that he can share more about the AQUIMON portfolio and also the performance of our flagship product.
Let's just recap on what Dr. Lei had mentioned. The last year, 2021, was seen as a great divergence between the US and the Chinese and Hong Kong market. So globally, you can see that US has been performing very well. If you look at the major indices, the equity market is around like 25% in return. And if you look at the Hong Kong and Chinese market, of course, it's actually performing as one of the worst markets in the world. But globally speaking, the average return will be around 20%. So the reason why I'm showing this chart is because this also replicates the performance at AQUIMON. Okay. So you can see this is our top performing thematic portfolio. You can see quite sadly it's all US-based portfolio. Of course, you can see that there's a jump from the traditional, what we call old economies. So we can see that the best performing thematic portfolios is the profit maker portfolio, has an annual return around 22%. And the volatility is pretty low. So we can see that also coherent to what Dr. Lei has mentioned, that we have actually a rebound from the COVID pandemic. And of course, the second best performing strategy is the also one of the best or one of the most popular strategies on AQUIMON is the global tech gen strategies. It has an annual return of around 20%. But if you look at the annualized volatility, actually, you can see that it's actually quite high, around 25%. And the reason why we see such a large volatility, of course, is because of there has been some pressure accumulating on the US market in the last 3 months, especially the expectation of like higher inflation and supply chain induced issue. And of course, in the coming third, fourth, and fifth places, they are all US portfolios. And you can see that even for the healthcare industry, it's performing quite well over the last year. It has a return of around 12%. So So now let's switch to the global asset allocation portfolio. The best performing portfolio, of course, is the Smart Global Ultimates portfolio, has an annualized return of 15%. And compared to the thematic portfolio, of course, these are all asset allocation portfolios. So comparatively, they have a lower annualized volatility and lower maximum drawdown, which means that for these kind of global asset allocation portfolios, it's a good investment vehicles or investment tool for you to actually to earn stable return and also to diversify your risk. Of course, the next best performing would be the Smart Global C portfolio. It has some crypto exposure on it. Within this portfolio, we have around a 5% Bitcoin exposure. So riding on the trend of cryptocurrency in this portfolio, we have a annualized performance of around 13%. So the volatility is quite good. And of course, if speaking of the Hong Kong market, if you switch to the Smart Global portfolio, which is a Hong Kong-based ETF portfolio, it has a return of only 8%. Of course, because of the recent bad performing in the Hong Kong and US market. But compared to the indices like the Hang Seng Index or the CSI 300, of course, we are confident to say that our Smart Global strategy has been quite stable. Over the year, it has not dropped a lot, so it can still provide stabilized return, and it has also shown the strength of our AQUMON algorithm. So right now, what you can see is actually the most popular portfolio in 2021. So as you can see from the chart, out of the 15 or 16 strategies on our AQUMON platform, the best selling strategies are, of course, the Smart Global Max, a US based ETF strategies, and the Hong Kong based ETF strategies. So when it comes to the client behavior on our platform, we can see that our client and AQUMON are usually long-term investor. They are looking for our flagship asset allocation portfolio, and they are looking for some tools or some portfolio or strategies that can provide long-term return to them. So when we speak to the thematic portfolio, we can see that the best portfolio are, of course, the tech portfolio. Both the global tech giants and the Chinese tech star portfolio are performing really popular over the past years. And right now, they are still the best or the most popular portfolio, the most popular thematic portfolio on our platform. So moving next to the global asset allocation strategies, we would like to give you a review of our Smart Global Max portfolio. It's actually our flagship portfolio launched since 2017. So you can see that it has a quite stable performance in the past 3 years. This product was launched in 2017, and from 2017 up until now, annually it has an annualized return of 18%. So even though with we have the pandemic going on in 2019 to 2020, we can still see that our global asset allocation strategy or portfolio are quite resilient to all kinds of market conditions. And from the historical performance, we can see that AQUMON's portfolio can actually generate quite stable return with relatively low volatility or risk. So moving on, since we have the successful launch of Smart Global Max portfolio in the past 3 years, so in 2021 we have actually launched an upgraded version of Smart Global Max portfolio, which is the Smart Global Ultimates portfolio. So we will categorize this portfolio as the ultimate globally diversified asset allocation strategies. So of course, when compared to Smart Global Max, it has a higher investment threshold. The minimum investment amount is around $13,000 which is approximately 100,000 Hong Kong dollar. And the underlying, of course, with a higher investment threshold, we can greatly expand the investment universe. So right now, we are not just covering the traditional US ETF market. We are also now expanding to the US stock market. So right now, it has an underlying of 60 plus stocks and ETF. So strategically speaking, is more diversified in terms of risk control. We can actually achieve a better outcome. And compared to the traditional Smart Global Max, because of the constraint for the investment threshold, it only covers a few regional stock markets. So with this Smart Global Ultimax, it can actually cover up to 12 regional markets. So it means for this portfolio, it has actually exposure for 12 plus regional markets. So digging into the portfolio details, of course, we have utilized a lot of our in-house invented algorithm. So for this portfolio, as I mentioned, it is a upgraded version of the Smart Global Max portfolio. So it actually embed 4 core investment algorithm or strategies. The first one, we actually have invented or embedded the smart hedging strategy, which means that it actually provides a hedging function against the major market. So we actually have added a VIX, the VIX, the volatility index, to the strategy, so make it more resilient and more risk tolerant. So whenever there's some volatility in the major market, actually this portfolio can actually react to the risk factor in a timely manner. So the second factor, of course, we also added the auto rebalancing function. So in the past, whenever you conduct a rebalancing action, we always have to come back and ask the approval from the clients. So from this strategy, we actually have introduced the dynamic monitoring and rebalancing function. So whenever there's some timely movement in the market, we can always respond to the market by asking our in-house algorithm to adjust the portfolio without asking the client's consent and wait for our client's confirmation. So actually with this new function, it can actually react to the market in a more timely manner. And of course, as I mentioned, this is a ultimate global asset allocation strategy. So it actually deploys our factor investment strategies. So we have added a lot of screening factors in the ETF and stock selection. So that's why we were actually framing it as the ultimate solution for our asset allocation portfolio strategies. So lastly, as I mentioned, this portfolio has exposure of up to 12 regional markets. How does it work? Of course, we actually has adopted the smart rotation strategy, which means that these portfolio will actually rotate and to the exposure for different stock market. Whenever we see a particular market has performed very well, say like for example, the Indian market in the past, 1 year has been very, very well. Of course, we will shift a little bit more exposure to some best performing market. Whereas for some underperforming market like the Chinese and Hong Kong market, we will of course adjust the weighting accordingly. So actually, moving on, you can see that apart from the traditional AQUMON app or the investment, we have actually invented a new product line, which is called the AQUMON Bespoke Service. It is actually a tailor-made investment solutions for our premium clients. So if you are planning to invest $500,000 or more, or you are already investing $500,000 or more, we are happy to provide a more tailor-made investment consultation with our in-house algorithm team, and our investment team will also be happy to contact you about how to optimize your portfolios. So how does this bespoke framework work? It's very easy. It's totally free of charge. So we are actually providing a tailor-made portfolio suggestion based on your current allocation. or if you have some additional demands, we can also frame our strategies up to your preference. So the procedure for this strategy is quite simple. So we just set up the meeting, and then we have some preliminary investment consultation and advice meeting. So we will just understand more about you, understand more about your investment preference, and understand your investment behavior. And based on that, we'll feed all the data into our in-house algorithm and data science team, and they will actually figure out a risk-adjusted portfolio and will suit your personal needs. So this is how the bespoke tailor-made service works. And of course, the benefits of having a bespoke service is actually we can adopt a more personalized strategies. And we also adopt the core and satellite framework to frame your investment. So if you are interested in this service, of course, we welcome you to contact us anytime. Or if you have any questions or maybe any comments about our product, you are always welcome to contact us on our WhatsApp, or even to drop us a call on our official line. Yeah. So may I ask if you have any questions for me or maybe for Dr. Lei? We are all happy to answer your question today. So maybe I will just answer to Kay's question. I think you are asking about the targeting absolute returns for this dynamic asset allocation portfolio. Actually, we have a benchmark for it. You can actually access to that on our app. So it's actually a mixture of MSCI World Index plus the Barclays Aggregate Bond Index. So if you are interested in viewing the benchmark performance and etc., we are always welcome to share the performance against the benchmark for you for reference. Okay. So may I ask if you have further questions? So one more from BF. So for your question, I think you're asking for Smart Global Ultimax portfolio. Does it include the China and HK stock right now? So at this moment, all the underlying are actually listed in the US market. So it does not include the Hong Kong or the Chinese stock market, but for a lot of the ETFs or a lot of equity listed in the US market, it actually has some exposure to the Hong Kong and US market. So just to put it simple, although we are not directly investing in the underlyings listed in the Chinese or Hong Kong market, but still for this strategy, it still has a certain percentage that has an exposure to the Hong Kong and Chinese market. Okay. So as I mentioned, this slide will actually will supplement what I have mentioned. So for this newly launched portfolio, we have a benchmark of MSCI World Index plus the aggregate bond, Barclays Aggregate Bond Index. So you can see that actually over the past 1 year, it has been outperforming our benchmark for a certain percentage. So you can see our performance here. So in case you have any questions, you also feel free to raise to us. So any more questions from audience? If no, then we can call it an end to the meeting. So just in case if you have any questions or feedbacks on our today's webinar or on our product, please feel free to drop us a WhatsApp message. And since the Chinese New Year is coming, so we would like to represent AQUMON to wish you an early Chinese New Year. And I wish you the best of luck, and please maintain in a healthy shape in the year coming. And thank you so much for your time today.
So thanks again for joining our webinar today. So we will share the webinar key takeaway and also the video recording to your registered email. So in the meantime, if you have any questions, just feel free to reach out to us. So thanks again.